Now we've started solving one or two problems with regards to the net present value method, which is another one of the techniques which we are using when it comes to calculating of capital budgeting. Now, in the previous few classes, we talked about the traditional methods of capital budgeting, wherein we talked about payback period and then the improvements to payback period. And additionally, we also talked about the accounting rate of return method. So today we're moving on towards the modern concepts or the discounting concepts of capital budgeting, and the first one under that is the net present value method. Now, while we've already solved a few sums, one or two sums pertaining to that, and since most of you were not there in the class, so we'll just solve additional few problems just to get a clearer picture or a clearer concept of what exactly it is that the net present value method is about. Now let's look at this question. An investment of rupees 25,000 having scrap value of rupees 1,000 yields the following returns. So we have the year, and then we have CFAT. Now CFAT, it stands for cash flows after tax. Okay, so CFAT is nothing more than our cash flows after tax. So these are nothing more than the inflows which we're getting after tax before depreciation. So CFAT in the first year is rupees 10,000, second year is 12,000, third year rupees 8,000, fourth year rupees 8,000 again, and fifth year rupees 5,000. And additionally, they've given us the cost of capital is 10%, which means this cost of capital, right, that we're having right here is our discounting factor. Okay, this cost of capital is our discount factor, also known as your PV factor. This is the rate at which we're going to calculate the present value for each of the cash flows after tax. So, is the investment desirable? We have to answer this particular question. Should we select the project or not? And they've asked us to discuss it according to the NPV method, assuming that the present value factors for first, second, third, and fourth year are to be 0.909, 0.826, 0.751, 0.683 and 0.620 respectively. Now in this question, they've given you a discount factor of 10%. Additionally, they've also given you the present value factors for each and every year from the first year until the fifth year, which means we can ignore this because we don't have to do the calculations anymore, because at the rate of 10%, if we take the formula that we normally use, 1 divided by 1 plus I to the power n, which means 1 divided by 1 plus 0.10 to the power of 1, right? 10%. So 1 divided by 1.0 to the power of 1 is going to be equal to 0.909, which is this here. Alright, so they've already given us everything. They spoon-fed us everything. We just have to prepare, or we just have to finalize the calculation of our net present values. Okay, so let's move forward to the calculation of the net present values now. Right, so if you remember when I gave you some notes pertaining to net present value, wherein we said that net present value is equal to present value of cash inflows minus the cash outflow, or also known as your capital outlay, minus capital outlay, or you have another name for it, cash outflow, or you can also call it as the amount invested or investment. Okay, so this is our formula for net present value. Now in this question, we have 5 years worth, right? In this question, we have 5 years. Each year we have to calculate the net present value, and then the total net present value that we're getting, right, that will be termed as the present value of cash inflows. Okay, you'll understand when we're doing it. So we have to prepare a table for this first. Prepare a table pertaining to calculations. Write down calculation of net present value, and under that we have to prepare a table with 4 rows: year, cash flows after tax in rupees, present value factor at the rate of 10%, and present value of cash flows after tax in rupees. Firstly, year, term it as row number 1 or column number 1, and then cash flows after tax, I'll give it number 2, present value factor, column number 3, and this will give me present value of cash flows after tax, column number 4. Okay, because remember, we have to take present value of cash inflows. We cannot just take the cash inflows directly, but because we're doing the net present value, so we have to calculate the value of the cash flows after tax today. Okay, the present value that they're having. Okay, so clearly from the question, we can fill up certain points easily. Firstly, under year column, first year, given already there, cash flow after tax to be rupees 10,000. So I'll write it immediately here, rupees 10,000. Similarly, for the others also, year number 2, cash flow after tax is rupees 12,000. Year number 3, cash flow after tax 8,000. Year number 4, it is rupees 8,000 again. And year number 5, I have rupees 5,000. Okay, so I have the cash flows after tax which I've taken directly from the question. And then when we're talking about the present value at the rate of 10%, again, this also I'm getting directly from the question right here. 0.909, this point onwards up to 0.620. Okay, so let me fill that also up. Present value at the rate of 10%. Firstly, for the first year, 0.909. For the second year, 0.826. Third year, 0.751. And then we have for the fourth year, 0.683. And for the final year, 0.620. These are given to us in the question. In case they haven't been given to us, remember, follow the formula. Okay, present value. Let's just do the calculation real quickly. Present value at the rate of 10%. Okay, so for the first year will be equal to 1 divided by 1 plus I to the power n, which is 1 divided by 1 plus 0.10 to the power 1 is equal to 1 divided by 1.10 to the power 1 is equal to 0.909. Okay, you can just do the calculations on your own. It will be easy to calculate. Okay, just like as we've done when we were calculating time value of money, if you remember, right? I've also provided you with the tables with regards to this calculation. So I'll just show you the second and the third year calculations as well. So for the second year, it's equal to 1 divided by 1 plus I to the power n, right? So it's equal to 1 divided by 1 plus 0.10 because 10% and n is the number of years, so to the power of 2 is equal to 1 divided by 1 plus 10 squared, which should equal to 0.82 and goes on to 0.826 approximately. And similarly for the third year as well, third year is equal to 1 divided by 1 plus 0.10 cube is equal to 1 divided by 1.10 cube is equal to 0.751. Okay, these are approximations. So if we're rounding up to 3 decimal points, they should give us these values that we have been provided with in the question itself. Okay, so now we have to calculate present value of cash outflows. Now from the term itself, present value of cash outflows, which means present value of multiply cash flows after tax. So which means we have to take row number 3, multiply it with column number 2. Okay, so column number 3 multiplied with column number 2. 3 into 2, which means 0.909 multiplied with 10,000. See how much we're getting. And then 0.826 into 12,000 and so on and so forth. Okay, right, so 10,000 into 0.909 for the first year should amount to rupees 9,090. For the second year, 12,000 are cash flow multiplied with the present value factor at the rate of 10% for the second year. 0.826 should give us rupees 9,912. And for the third year, 8,000 into 0.751, 6,008. And for the fourth year, 8,000 into 0.683 should give us rupees 5,464. And for the last year, 5,000 into 0.620 should amount to rupees 3,100. Okay, so these are all of the cash flows that they've given to us in the question, right? If we look at the question once again, they've provided years 1 to 5 with distinct cash flows respectively. However, if you look at the first line in the question, they've given you an investment of rupees 25,000. Okay, so from this point itself, we can see that this amount is the amount invested, also known as the cash outflow or the capital outlay. So I'll write it here as capital outlay. Okay, so this 25,000 is capital outlay, and additionally having scrap value of rupees 1,000. scrap value of rupees 1000. Now scrap value, we already know what it means. It refers to the salvage value, or the amount a company gets once it sells off the project after the lifetime of the project. Okay, which means that this particular scrap value, right, the amount of rupees 1000 is it is an amount which we are supposed to be getting only after the project is sold. So project can only be sold, or the asset can only be sold at the end of the lifetime of the project, which means after 5 years. Okay, project can only be sold once the entire, the asset can only be sold once the project is completed. So only once the 5th year ends, only once the estimated life ends can this project be sold, which means once again, this rupees 1000 is something that we're getting after 5 years. So again, we have to calculate what is the present value today. Okay, this is the amount we're getting after the project terminates, which is year number 5. Got it? Okay, so again, we're getting this amount, which means it is another cash flow. So in the table, I'll be writing another cash flow, rupees 1000, which is my salvage value. Okay, so we can write it here, small salvage value in the year column. Okay, now if you want, just as a reminder for yourself, you can write this here on 5th year. Okay, because you're selling it after the project terminates in the 5th year, which means if it's been sold in the 5th year, it means that we have to calculate the present value for this also. How much is it worth today? So we have to calculate it based upon the same present value factor, which is 0.620. Okay, you understand why? Because on the 5th year, and in the 5th year, our present value factor is 0.620. That is why I have to apply 0.620 even to the salvage value of rupees 1000. Okay, so I hope it's clear. So for this also, we have to calculate present value. So 0.620 into rupees 1000 should give us rupees 620 as the present value of our salvage value. So now the next thing for us to do is, as per the formula, present value of cash inflows, and since there are so many present values, we have to take their totals. Okay, so close down this row right here and then calculate the total of the present value of cash flows after tax. So after calculating, I'm getting present value of cash flows after tax. So the total 9,090 plus 9912 plus 6,008 plus 5464 plus 3,100 plus 620. I'm getting the total present value of cash flows after tax to be rupees 34,194. Okay, now as a question, as our formula, net present value is equal to present value of cash inflows minus capital outlay or cash out for investment. Okay, so now that I have already this part of my equation, I only need this part, which we've already pointed out to be rupees 25,000. So I can either, stop here and then prepare a statement, or I can just deduct it from here and get my total present value of cash outflows. Okay, so while I did make a mistake of not estimating how much space I needed, I hope it still be visible, it'll still be clear for everyone. Okay, so from here, I'll just deduct minus, okay, we'll just write it as original investment as is given in a question. In a question is given investment, right? So I'll just write here also minus investment. Minus investment. So investment is rupees 25,000. So now it will be equal to your 34,194 minus 25,000 should be equal to rupees 9,194. Okay, rupees 9,194. Now this total is equal to net present value. Okay, this amount of rupees 9,194 is the solution to our problem. Got it? Net present value is equal to 9,194. Now, our solution does not end here, because additionally, they've also told you, if you go once again to the question, you'll see that they've told you to, is the investment desirable? Okay, they've asked you also, is the investment desirable, and discuss it according to the NPV method. So now we've already done all the calculations as per, as has been asked for us in question. Only thing left for us to do is to understand or to answer this question, whether the investment is desirable or not. So when it comes to net present value, if you remember, net present value, the project that should be selected should always be one which is positive. Okay, any project which has a positive NPV is desirable for the firm, and in this situation also our present value is positive 9,194. Therefore, we can conclude that this project is desirable. Okay, so make sure we are writing a conclusion. Okay, so this is just a small working note, right, for you. You can write it, you may not write it depending upon you. Okay, so you can exclude that. Okay, so in conclusion, therefore, we'll write down therefore the firm can opt for this project. Therefore, firm can opt for this project as the net present value is, or the NPV is, a positive figure. Okay, or in other words, you can also write since the NPV of the particular project is positive, therefore the firm can choose this project. Okay, so this is one. Now let's just look at another question. Now the question has been given to us: calculate the net present value, and you have initial outlay or investment rupees 1 lakh, estimated life is for 5 years, and we have the scrap value, or also known as our salvage value, amounting to rupees 10,000, and we have the profits after tax, or as we now know them as CFAT, cash flow after tax. So at the end of year 1, 6,000, year 2, 14,000, year 3, 24,000, year 4, 16,000, year 5, no. Additionally, they've given to us depreciation has been charged under straight line method, and the cost of capital may be taken at 10% per annum. Okay, so cost of capital, as we already know it by now, it is to be I. So I is at the rate of 10% per annum. Okay, interest rate is equal to 10%, or how we use it now, 0.10. Okay, now if you look at the question clearly, they've given to you cash flows after tax, but they've also given to you depreciation. Now, if in these kinds of questions they've given to us cash flow after tax and they've also included depreciation, it means depreciation has been charged. Okay, it means depreciation has been charged, and it means that we have to add back this depreciation. So whenever we're calculating net present value, okay, whenever you're calculating net present value, always remember that the cash flows we're using are going to be your cash flows after tax, but before depreciation. Okay, we're always going to be using, I'll just write it here, cash flows after tax, but before depreciation. Now, unless, of course, unless they haven't mentioned this, okay, unless they have mentioned this area here, depreciation and all that, if they've not mentioned anything about depreciation, then just take the cash flows as they are. However, because in this question they've specifically mentioned that depreciation has been charged, and they've given also the method of your depreciation, which is the straight line method, therefore we have to add back our depreciation, okay, which means depreciation has been deducted, but because we have to take cash flows after tax but before depreciation, so we have to add back the depreciation. Okay, so once again, whenever we are calculating the net present value, our cash flows that we're using, they are always going to be cash flows after tax but before depreciation. Now, if the question is like the previous question that we solved, wherein they've just given us cash flows after tax and there's no mention of depreciation at all, then just take the cash flows as they are. However, now under this question specifically, they've mentioned to you that depreciation has been charged under straight line method. So it means that we have to take this particular topic of depreciation into consideration. Okay, we have to calculate the amount of depreciation that has been deducted, and then we have to add back the depreciation to our cash flows after tax. Okay, I hope it's clear. The explanation, I'm trying to make it as simple as possible. If in any way the explanation is still unclear to a few of you, feel free to contact me. You can always text me and ask me about it. Okay, so let's move forward to the calculation of our net present value. And before we do that, remember we said because we're using cash flows after tax but before depreciation, firstly we have to calculate depreciation. Only after calculate depreciation can we calculate the actual amount of cash flows after tax. Okay, so first, calculation of depreciation. Okay, so we can prepare this as a side note or as a working note. Okay, so write down working note, calculation of depreciation. So it's been given to us clearly how much the depreciation or how the depreciation is to be charged. So depreciation is being charged as per SLM using straight line method, calculation of depreciation. Now, in case of depreciation under straight line method, you remember the formula, initial cash flow divided by estimated life of the project, right? Therefore, depreciation is equal to initial, or the cost of the asset, initial outlay, or initial cash flow divided by estimated life of the project. Estimated life of project. Now, in this situation, we also have a salvage value. Okay, besides the cost of the asset, we also have a value of the asset we're going to receive once it's been sold off. So that has to be deducted from the calculation of depreciation. So minus salvage value. Okay, we're just using the basic formula. So it should be equal to initial outlay is rupees 1 lakh minus salvage value amounting to rupees 10,000 divided by estimated life of the project is 5 years. So this should be equal to 90,000 divided by 5 is equal to rupees 18,000. Okay, so we have the value for depreciation. Now we have to calculate cash inflow before depreciation but after tax. Okay, so the next step, again, you can term it as another working note. So I'll list this as working note number 1, and then I'll give you the second working note now, working note number 2, which is calculation of cash flows after tax but before depreciation. Now, if you're comfortable writing, instead of putting the acronym, if you're comfortable writing it full, cash flow after tax, to make it easier for yourself, you can do that as well. There's no harm in it as long as you understand what it is that you're writing about. Okay, so let's prepare a table for this. Right, so I've prepared a table with 4 columns. Year profit after tax in rupees, depreciation in rupees, cash flow after tax before depreciation in rupees. Okay, so the year, there are 5 years. You can see that clearly from the question. Okay, let's look at the question once again while we are jotting down, filling up these areas here. Okay, so year number 1, profit after tax is rupees 6,000. So I'll just fill this up real quickly. Profit after tax 6,000 rupees. Year number 2, profit after tax is 14,000. Year number 3, it is rupees 24,000. Year number 4, rupees 16,000. Year number 5 is nil, so I'll just put a 0 out there. Okay, so we have the profits after tax, which we've taken directly from the question, and then the depreciation column. Now, depreciation is under straight line method, and if it's under straight line method, it means that every year the same amount of depreciation is going to be charged, correct? So depreciation is rupees 18,000. So under each year, adjacent to each year, under the depreciation column, I'll be writing the same amount, which is rupees 18,000. All right, rupees 18,000. Now, the only column left is cash flows after tax before depreciation. So profit after tax or cash flows after tax before depreciation means we have to add back depreciation. Okay, before depreciation. So we have to add back depreciation. Now, if I were to number each of these columns, this last column is going to be column number 2 plus column number 3. Okay, very simple. Cash flow before depreciation. This is profit after tax. Cash flow after tax. Before depreciation means add back the depreciation. Okay, very simple. So cash flow for the first year, 6,000 plus 18,000 should be equal to 24,000. Second year, 14,000 plus 18,000 should be equal to rupees 32,000. Third year, 24,000 and 18,000 should be rupees 42,000. And for the fourth year, it should be equal to rupees 34,000. And for the fifth year, it should be equal to rupees 18,000. Okay, now we have officially the values which we can use for calculating our net present value. Okay, this row number 4, right, is what we're going to be using for calculating the net present value. Okay, so now let's move ahead to the actual calculation or the actual sum. Okay, so I've prepared my table for calculation of the net present value, and just like as before, here cash flows after tax in rupees, and then present value factor at the rate of 10%, and then present value of cash flows after tax again in rupees. So I filled up everything basically. Here I have 1 to 5. Cash flows after tax, the amount that I'm taking, please remember, are these values here. This row number 4. Okay? Cash flows after tax before depreciation. So 24,000, 32,000, and then you have 42,000, 34,000, and 18,000. Okay, just these values I'm writing here under cash flows after tax before depreciation. And present value factor at the rate of 10%. Now I always like to write down the formula right here, just for my examiners to see, and it makes it easier for me also to remember, just in case there is a slight chance that I forget how I got these calculations. I just like to write that here. Okay, so 1 divided by 1 plus I to the power n. And again, it's not mandatory. If you're comfortable, if you're very, used to the formula by now, then you don't have to do that. So anyway, I'm not doing calculations anymore because we've already done those in the previous few sums and in the previous unit as well. So I have gone forward and written the present value factor straight away. So in the first year, 0.909, second year, 0.826, third year, 0.751, fourth year, 0.683, and in the fifth year, 0.621. Only thing left for me to do is to calculate present value of cash flows after tax, which is CF80 into present value factor. Okay, so for the first year, 24,000 into 0.909 should give me 21,816. For the second year, 32,000 and 0.826 should amount to 26,432. Third year, 42,000, 0.751, 31,542. Fourth year, 34,000 and 0.683, 23,222. And in the fifth year, 18,000 and 0.621, rupees 11,178. Alright, now in the previous questions, whenever we had a salvage value, we normally add it back, right? We normally add that salvage value as a part of our cash flows after tax. However, in this situation, I'm not going. So the salvage value in this situation also will be adding it. Amount of salvage value. Firstly, under the year column, salvage value, rupees 10,000. Right? Salvage value, rupees 10,000. And because we know salvage value is an amount that we're getting only at the end of the lifetime of a project, so only after 5 years. So remember, the value of the PV factor is 0.621. So 10,000 into 0.621 amounting to rupees 6,210. Right? Okay. So till this much, I believe we're very comfortable till here solving all these problems. Alright. So the next step is to just calculate the total present value. So next is total present value of cash flows after tax. Cash flows after tax, CF80. So 21,816 plus all these values. Let's see how much we're getting. Please do the calculation. It should come to about 1,20,400. And from this, you remember, right? Less our initial outlay. Less initial outlay or cash outflow or original investment, amounting to rupees 1 lakh. So we're getting our net present value to be equal to rupees 20,400. Okay, so the final answer is rupees 20,400. This is our net present value. Now if they ask you a question whether or not you should select a project in this situation, because you can just write, since the net present value of the project is a positive figure, which is rupees 20,400, therefore the company can select the particular project. Okay, so this is net present value.